Hello everyone, myself Namita Suresh Mahadik and my presentation topic name is Debt Securities. Debt Securities definition. The term debt securities has a number of meaning, but generally it refers to financial instruments that contain a promise from the issuer to pay the holder a defined amount by a specific date. The point at which they are negotiable instrument, which means that ownership can be transferred from one party to another easily. Bonds, corporate municipal, are one of the most common type of the debt securities, but there are many different examples of debt securities. Include preferred stock, collateralized debt obligation, euro commercial paper and mortgage-backed securities. What exactly are securities? Securities are fungible and traded financial instruments used to raise capital in public and private markets. Negotiability refers to the fact that its legal ownership is readily capable being transferred from one owner to another by deliver or endorsement. What is debt security? A debt security is a negotiable financial instrument serving as an indicate of a debt. What are listed debt securities? Listed debt securities mean debt securities of the company that have been admitted to trading on a regulated market. What are debt securities markets? The market is the where debt instruments are traded. Debt instruments are assets that require a fixed payments to the holder, usually with interest. Example of debt instruments include bonds and mortgage. Types of debt securities: term loan, lease, debenture, bonds. A term loan. A term loan is a monetary loan that is a repaid regular payments over a set period of time. Term loan can be given on an individual basis but are often used for a small business loan. Term loan purpose can be new industrial units, expansion, purchase, second-hand machinery. Term loan are a good way to quickly increase in capital in order to raise a business supply capabilities or range. Term loan is a whether the interest rate is a fixed floating. Institution offer a variety of repayments plans for your term loan. Lease. A lease are defined as a contractual arrangements in which a party owning the assets provide the assets for use to another transfer the rights to use the equipment to the user for an agreed period of time, return for a periodic payment. Property may be obtained by leasing such as a motor vehicle, building, construction equipments, computers, aircraft, shipped and other office equipments. Essential elements: parties to control assets ownership separate from user, term of lease, lease rental, type of leasing, operating lease, financial lease, sales and lease back leverage lease. Debentures. A debentures is a debt securities issued by a company which offer to pay interest of the company borrowed for a certain period. These are long-term debt instruments issued by private sector companies. These are issued in a denominations as low as rupees 1000 and maturities ranging between 1 and then 10 years. Debentures were issued in a physical form. Now corporate PSU have started issuing debentures in a demat form. Debentures can be listed on a stock exchange, giving you an opportunity to sell then exit earlier than the maturity of the debenture. Types of debenture: basic of convertibility, non-convertible debentures, convertible debentures, basic of security, secured debentures, unsecured debenture, basic of redemption, redeemable debenture, non-redeemable debentures. Bond. A debt investment in which an investor loan money to an entity that borrow the funds for a defined period of time at a fixed interest rate. Bonds are used by companies, municipalities, state and foreign governments to finance a variety of projects and activities. Bonds are referred to as a fixed income securities. Interest on a bond is usually paid every 6 months. Bondholders have a creditor stake in the company that they are lenders. Being a creditor's bondholder have a priority over stockholder. Bond usually have a defined term or maturity after which the bond is redeemed. Thank you.